For most people, global markets feel distant, almost abstract. Numbers move on screens, headlines flash for a few hours, and life goes on. But every so often, something happens that quietly changes the mood beneath the surface. The sudden $50 billion shift was one of those moments. It didn't arrive with a single dramatic announcement or a clear villain. Instead, it slipped into the system and altered how money behaved, how investors reacted, and how confidence itself was priced. At first glance, $50 billion may not sound world-shaking in a system measured in trillions. Yet markets don't move on size alone. They move on direction, speed, and surprise. This shift happened fast, crossed borders, and caught major players slightly off balance. Within hours, liquidity patterns began to change. Trades that once felt routine suddenly required more caution. Risk desks paused. Algorithms adjusted. Something had tilted. What made this moment different was where the money moved from and where it went. Capital didn't simply vanish, it relocated. Safe assets absorbed some of it, while other areas felt an unexpected vacuum. When money leaves quietly, it sends a message louder than panic ever could. It suggests anticipation, not fear. Someone knows something, or at least believes they do. Bond markets were the first to reflect the tension. Yields twitched in ways that didn't match recent trends. Small movements, almost polite, but persistent. Currency desks noticed it next. Certain exchange rates stopped behaving normally, drifting instead of snapping back. These weren't crashes. They were hesitations. And in financial systems, hesitation often matters more than chaos. Equity markets reacted later, as they usually do. Stocks didn't collapse, but the confidence behind them thinned. Rallies felt shorter. Dips felt heavier. Investors who had been comfortable buying weakness began to wait. That waiting changed the rhythm of trading days. Volume shifted. Volatility stopped being loud and started being sneaky. Behind all of this was psychology. Markets are stories people tell themselves with money. For months, the dominant story had been stability with manageable risk. The $50 billion shift didn't erase that story, but it edited it. A new footnote appeared, watch closely. And once that note is there, it's hard to ignore. Institutional players felt it most. Pension funds, insurers, and large asset managers don't react emotionally, but they do react structurally. Rebalancing models adjusted. Exposure limits were reviewed. Not because disaster was expected, but because certainty was no longer free. Even a small doubt, when multiplied across massive portfolios, changes behavior. For everyday observers, nothing seemed broken. Markets still opened. Prices still moved. But under the surface, trust had thinned just enough to matter. The system hadn't cracked. It had shifted its weight. And once weight shifts in global markets, the aftereffects rarely stay contained for long. When a large sum moves suddenly, the real story isn't the exit. It's the destination. After the $50 billion shift, analysts didn't just ask why the money moved, they asked where it chose to hide. The answer revealed something deeper about how global confidence was being reshaped. A noticeable portion flowed into government bonds, but not evenly. Short-term debt attracted attention first. Investors weren't locking money away for decades, they were buying time. This kind of behavior signals uncertainty without surrender. It says, I'm not running, but I'm not committing either. Long-term bonds, which usually benefit most from fear, lagged behind. That imbalance told its own story. Another stream moved into currencies seen as stable, but again, selectively. The dollar strengthened in some corridors but weakened in others. This wasn't a vote of blind faith. It was a tactical choice. Capital sought flexibility, places where it could park briefly and move again without friction. Liquidity, not yield, became the priority. Commodities reacted in a more complicated way. Gold saw interest but not euphoria. Prices edged higher, then stalled. That pause mattered. It suggested that investors were hedging, not panicking. Energy markets showed similar behavior. Oil prices wobbled, caught between slowing demand signals and geopolitical tension. Nothing exploded, but nothing felt calm either. Emerging markets felt the shift most sharply. For years, they had benefited from excess global liquidity searching for higher returns. When $50 billion stepped back, even partially, those markets felt exposed. Currencies weakened. Borrowing costs rose. Governments that relied on steady inflows suddenly faced harder math. Not because conditions had collapsed, but because assumptions had changed. What's important here is intention. Money moving into safety out of fear behaves differently than money repositioning out of caution. This shift looked like the latter. Investors weren't bracing for impact, they were repositioning for optionality. They wanted the ability to react quickly if conditions worsened or improved. That desire alone can reshape markets. Technology-driven trading amplified these effects. Automated systems picked up on subtle changes in flows and reinforced them. A small move became a pattern. A pattern became a signal. And signals, once recognized, spread faster than logic can contain them. Humans noticed what machines were already acting on. This is how market narratives evolve. Not through declarations, but through behavior. The $50 billion didn't announce a crisis. It introduced a question. And markets, uncomfortable with unanswered questions, began adjusting around that uncertainty. For long-term investors, this moment created a quiet divide. Those focused on fundamentals stayed put, trusting earnings and growth. Others, more sensitive to macro shifts, leaned defensive. Neither side was wrong. They were simply responding to different clocks. By the end of the week, one thing was clear. The system had absorbed the shock, but it hadn't forgotten it. The money had settled for now. But its movement had redrawn invisible lines. Lines that would influence decisions long after the headlines faded. What made the $50 billion shift truly powerful wasn't the money itself, but how people interpreted it. Markets don't move on facts alone, they move on shared beliefs about what those facts mean. Once the shift became visible, perception started doing more damage than the transaction ever could. Traders began asking a dangerous question: what does someone know that I don't? This question spreads faster than panic because it feels rational. Nobody wants to be the last person holding risk when others are quietly stepping away. Even investors who hadn't planned to change positions began reassessing, not because conditions demanded it, but because behavior around them had changed. This is where hesitation becomes contagious. Decision-makers delayed commitments. Deals slowed. Large funds reduced position sizes, not exiting entirely but trimming exposure just enough to feel safer. Each small action reinforced the sense that something was shifting beneath the surface. The market entered a state of alertness, not fear, but readiness. Media coverage accelerated this process. Headlines framed the movement as a signal, then as a warning, and eventually as a turning point. Each escalation added emotional weight. The story grew larger than the data. Context was compressed into drama, and nuance gave way to narrative. Once that happens, logic struggles to keep up. Retail investors felt this indirectly. They didn't track bond spreads or currency corridors, but they noticed volatility. Portfolios flickered red and green more than usual. Financial influencers framed the moment as either an overreaction or the beginning of something bigger. Conflicting interpretations created cognitive noise, which often leads to inaction or impulsive moves. Institutional players, meanwhile, watched sentiment indicators closely. Volatility indexes ticked upward, not violently, but persistently. Correlations between assets tightened. When everything starts moving together, it suggests psychology is overriding individual fundamentals. That's a warning sign professionals take seriously. What's subtle here is timing. The real psychological impact didn't peak on the day the money moved. It unfolded over days. Each quiet session without clarity made the uncertainty heavier. Humans tolerate bad news better than ambiguous silence. The lack of confirmation kept minds searching for meaning. This is how markets drift into fragile states. Not through crashes, but through unresolved tension. Confidence erodes slowly, replaced by conditional thinking. I'll stay invested unless. Those invisible conditions pile up until one small trigger pushes many people to act at once. Yet there was also restraint. Not everyone reacted. Long-term capital, pensions, and sovereign funds largely held their ground. Their presence acted like an anchor, preventing sharper dislocations. This contrast between fast money and patient money defined the mood. One side was nervous. The other was watchful. The most important outcome of this phase wasn't price movement. It was memory. Markets remember moments when confidence wavered. The next time stress appears, this $50 billion shift will resurface in people's minds as precedent. That memory will shape reactions faster next time. In that sense, the event didn't end when the money stopped moving. It embedded itself into collective awareness. And once perception changes, markets are never quite the same again. After the initial shock and the psychological ripple, something quieter but more revealing happened. The market began sorting itself out. Not everything fell. Not everything rebounded. What stayed standing told a deeper story about what the $50 billion shift actually changed and what it didn't. Assets tied to long-term productivity showed resilience. Companies with stable cash flows, low debt, and global demand didn't move dramatically. They wobbled then settled. This suggested that the core economic engine hadn't stalled. The shift wasn't a rejection of growth itself, but a reassessment of how growth should be priced under uncertainty. Highly leveraged sectors felt the pressure longest. When liquidity tightens, leverage stops looking clever and starts looking dangerous. Real estate investment vehicles, speculative tech, and complex derivatives saw continued caution even after volatility cooled. Capital became selective, not scarce. That distinction matters. Currencies offered another clue. The dollar didn't surge as much as fear-driven narratives predicted. Instead, it moved unevenly, reflecting competing forces. Safety demand pulled it up, but debt concerns capped enthusiasm. This balance hinted at a world no longer defaulting to one single anchor, but juggling several imperfect ones. Bond markets calmed faster than expected. Yields stabilized, signaling that institutional investors believed the system could absorb the shock. This wasn't blind optimism. It was conditional confidence, belief that central banks still had room to maneuver, even if credibility was thinner than before. Behind the scenes, risk models were being rewritten. Assumptions about correlation, speed, and spillover effects were adjusted. Stress scenarios that once seemed extreme now felt realistic. This recalibration won't make headlines, but it will influence decisions for years. What comes next depends less on the original $50 billion and more on responses to it. If similar shifts repeat, markets may harden, reacting less emotionally each time. But if the next move comes from a different corner, this event will amplify the response, not dampen it. Context stacks. For policymakers, the lesson is restraint paired with clarity. Overreaction risks validating fear. Silence risks fueling it. Markets don't need constant intervention, but they do need signals that someone is watching the whole system, not just one pressure point. For investors, the takeaway isn't panic or confidence, it's awareness. Sudden movements are no longer anomalies. They're features of a world where capital moves faster than narratives can catch up. Positioning matters, but so does patience. The $50 billion shift didn't rewrite the global financial order. It exposed its sensitivity. It reminded everyone that stability is often assumed right until it's tested. And once tested, it demands attention. What changed most wasn't valuation or policy. It was mindset. Markets became more alert, more conditional, more memory-driven.